Hi, I'm Andy Myers with the latest announcement on sovereign debt from Weiss Ratings. The nation's leading independent rating agency of U.S. financial institutions and sovereign debts has downgraded the government bonds of Hungary, Ireland, Portugal, Russia, and Sweden. Weiss downgraded Hungary's rating from C to C-, Ireland from D- to E+, Portugal from D+ to D, Russia from B to C+, and Sweden from B+ to B. The cuts underscore the impact of the Eurozone's debt crisis on the world economy. Ireland, in particular, faces difficult years ahead. Its government is likely to implement additional austerity budgets, and its banking sector faces mandatory contraction. So Ireland is especially vulnerable to a general European recession. The economy has shown some indications that the initial austerity measures will place the country on stronger footing, but at the cost of mass unemployment and immigration. To reduce the impact of the austerity measures, Ireland's government has stubbornly refused to give up its low corporate tax rate, maintaining its advantage when competing for foreign investment. Meanwhile, Portugal's economy continues to deteriorate and is likely to face a major contraction in 2012, perhaps as much as 3%. Substantial European assistance has been promised, but is contingent on privatization of national industries, such as Portugal's airlines, power, and the national energy grid. Hungary is suffering from the relative strength of the Swiss franc and the euro compared to its own currency, the forint. Since April, the forint has dropped 17% against the Swiss franc, and it has fallen nearly 10% against the euro in just the last 3 months. The weakness of the forint, combined with substantial borrowing in foreign currencies by Hungarians, has made it difficult for citizens to repay debt and may lead to an economic contraction. Russia faces major challenges. It is increasingly vulnerable to the financial crisis in Europe, causing markets to question its economic stability in light of risk factors and recent history of default. This, coupled with dependence on high energy as well as other export commodity prices and tightening liquidity, indicate that the macroeconomic picture is not strong. Finally, we have Sweden. Despite that country's overall economic strength and fiscal prudence, it too is feeling the effect of the Eurozone crisis. Sweden's property market is showing signs of stress, with prices trending down in many areas and extended time to sell. The government has recognized the banking industry's exposure to the financial markets and is committed to strengthening the industry by implementing higher Tier 1 capital requirements. Declining debt levels and the attractiveness of Swedish bonds are expected to help maintain economic stability. Weiss Ratings senior financial analyst Gavin Magor sums up the ratings changes, saying, with a potential new recession on the horizon, some countries are particularly exposed. While a tighter fiscal union proposed by Germany and France intends to maintain a core of stability around the two countries, it would take significant time to implement if an agreement is ever reached. The European financial crisis is as large as ever and will continue to cause difficulties as it develops well into 2013. For the Weiss sovereign debt ratings on all 50 countries covered, please go to weissratings.com/sovereign debt ratings. For Weiss Ratings, I'm Andy Myers.